Good morning. It's Monday, the 6th of May, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, India's financial capital. Our top stories and themes for the day: why world markets are looking for bad news from Wall Street. Kotak Bank's CEO says he's worried about the bank's reputation because of a RBI crackdown. Should he be saying this? Why home loans have jumped dramatically in 2 years? Where will India's multi-billion-dollar semiconductor subsidies stop and when? And Warren Buffett meets shareholders at the annual Berkshire Hathaway meeting without Charlie Munger for the first time.
This is a core report with Govindraj Ethiraj.
Why world markets are looking for bad news? Oil is down. A market fall on Friday in India was blamed on a news report suggesting that there may be increased capital gains taxes on incomes from sale of shares. Now, this is not a new thought, and politicians usually, regardless of hues, tend to consider it often, more so when capital markets have seen such considerable appreciation in recent years. The specific rumor was that the Income Tax Department would impose uniform treatment for all asset classes when the government came to power or returned to power, as the expectation is. The finance minister was quick to deny this, and it is possible she is either not aware of some thinking down the line, or it is an active thought in the ministry, but only a thought, which is where or how a television station picked it up. Now, any effort to increase taxes on stock market gains will obviously defeat the whole hope of continuity, which is also economic continuity, apart from the political continuity which the markets are primed for. Markets also tend to get upset when there is the slightest suggestion of more taxes. Current tax rates are 15% for short-term gains or profits, which is less than a year, and 10% if the shares are held for more than a year, if over 1 lakh rupees. So stocks staged an about turn on Friday thanks to this, with the Sensex falling over 1,000 points intraday and then closing down 733 points to end at 73,878. The Nifty 50 closed at 22,476 and down 173 points. The BSE mid-cap and small-cap indices were also down, but marginally. Now, on Wall Street, it's actually waiting for bad news, if you look at it or even think about it. Every time the job market is too hot, inflation too high, or growth too strong, interest rate cuts by the Federal Reserve become more distant. The only hope is that one of these factors reverses, which could cause the Fed to cut rates or at least start cutting them, which in turn would make flows into equities stronger, not just in the United States, but also globally, either directly or as triggers. India is obviously part of the receiving pack and thus could benefit. On Friday, stocks on Wall Street jumped thanks to a softer than expected April jobs report. The Dow Jones Industrial Average gained 450 points to close at 38,675. The S&P 500 was up, and so was the Nasdaq Composite. So Friday's non-farm payroll report in the United States showed less jobs gained than was expected by economists, said CNBC, and the unemployment rate was up to 3.9% versus 3.8%. Wage figures also came in less than expected, an encouraging sign for inflation. Now, obviously, this means that if the jobs numbers are not as strong in the United States, then there is cause for interest rates to be cut so as to obviously incentivize the economy. But this is now, and this could change. So let's stay focused on what happens next. Back home, the primary market will see major offers this week from 3 companies: Blackstone-backed Aadhar Housing Finance, healthcare tech firm Indegene, and travel distribution firm TBO Tech. The collective amount is 6,400 crores rupees, which is large, according to Business Standard, which also pointed out that since 2004, there hasn't been a single IPO launch or initial public offer launch during May in the last 4 general election cycles. Meanwhile, some positive macro numbers. Oil prices were quoting below $83 a barrel over the weekend, suggesting even lower demand expectations, and that there would be some peace moves in the Middle East, though there was no outward sign of that happening over the weekend. Kotak Bank CEO says he's worried about a reputation hit because of the Reserve Bank of India's move. Should he be saying that? The Reserve Bank of India's regulatory order on Kotak Mahindra Bank has impacted its franchise and reputation, even though its financial impact is expected to be minimal, Reuters reported its CEO Ashok Vaswani, who took over in January, as saying. Last week, the Reserve Bank of India asked Kotak to stop adding clients digitally and issuing credit cards due to gaps in its IT infrastructure. Kotak Bank CEO said that the Reserve Bank of India order obviously has had an impact both on our franchise and our reputation, which does not feel good. And he promised that Kotak was committed to coming back strongly, and that was their number one priority. The bank would double its efforts, resources, and money in addressing IT-related issues, he said, adding that the bank currently spends 10% of its total expenditure on information technology. He also added that they were working with the Reserve Bank to appoint an external auditor for IT systems, and the process should be completed soon. Now, Kotak Bank also saw a sudden exit of Joint Managing Director KVS Manian last week, all of which led to a 16% drop in its share price over the past 6 trading sessions. Manian was also seen as a contender for the CEO's position, which he did not get, and has been around for almost 3 decades in the Kotak system. Kotak Bank's CEO was technically right to acknowledge or say that there was a greater reputation impact as opposed to a business impact. Now, which is true for various reasons, including the bank's own competency levels, which everyone believes in, including in the stock markets. Most people would expect it to get back on track as far as business goes, as did, let's say, in the case of HDFC Bank, when the Reserve Bank of India in December 2020 asked it, that's HDFC Bank, to stop issuing fresh cards and cease digital transactions. Actually, a move which was quite similar to what befell Kotak Bank recently. A full return to normalcy for HDFC Bank only happened in March 2022, at which point it plunged back into the market for credit cards with a vengeance. Now, there is a small nuance here. Referring to a reputation impact directly sounds almost like you're standing outside the arena rather than within it. The right thing to do, of course, is to own up to the mistake, let's say in this case, not having invested in sufficient infrastructure to keep pace with growth or pushing growth without investing in infrastructure, though, of course, all of this would have happened before the current CEO came into his position. Owning up to the mistake and then speaking about remedial actions, which the CEO did so, is fine, more specifically stepping up investment in that IT infrastructure. But the context is a little fine because the company is saying that the hit on reputation is more than it is on its business. So my next question could have been, does that mean you can fix the business but not the reputation so easily? And this is not something that I'd like to hear from leadership, however true it might be. So this is just a nuanced point on how it came across, or at least how it was reported. I'm sure, as many others feel, that Kotak Bank could recover and be back on its feet very soon. Home loans are jumping. All the figures we've been seeing from the property consulting firms on shooting housing sales in the big metros particularly are reflecting in the Reserve Bank of India's numbers. Sales have, of course, jumped post-COVID at levels and rates not seen before, led by cities like Mumbai and Delhi, which is seeing supply and demand for larger transactions as well, in addition to smaller transactions. Credit outstanding to the housing sector has risen by nearly 10 lakh crore rupees in the last 2 years to reach a record 27 lakh crore rupees, according to the Reserve Bank of India's data on sectoral deployment of bank credit, according to Business Standard. According to the data of the Reserve Bank of India, the credit outstanding to the housing that includes priority sectors stood at 27 lakh crore in all, and this figure was 17 lakh crore in March 2022 and 19 lakh crore in 23. So from March 22, 17 lakh crore to 27 lakh crore in March 24. That's a substantial jump. While this is a significant jump and reflects a certain degree of rising indebtedness in the Indian economy, it's also good news because these loans are linked to hard assets as opposed to unsecured loans, and also means that more and more Indians are buying homes, though all of it may not be for primary consumption. India's chip race. How many billions of dollars can we afford? There is a chip race going on, and it's a global one, something we've been referring to in the core report periodically. Let's start with India first. Construction of 3 semiconductor plants worth about 126,000 crore rupees or $15 billion by companies like Tata Group and CG Power have either kicked or kicking off. Roughly half this cost, let's say about $7 billion, will be in the form of direct subsidies from the government of India. Now, the Tatas are setting up 2 of those major plants, one in Assam and the other in Gujarat. Very broadly, again, something that we've touched upon, chips range from 3 nanometer chip, which could be used in the latest iPhones, let's say, to 28 nanometer mature or legacy chips used for automobiles, consumer electronics, and defense applications. Now, chips are considered akin to defense equipment in terms of sensitivity because breakages in supply chains, whether for physical or geopolitical reasons, can cause havoc in a country's economy, as we saw during COVID, where, for example, auto production slowed down because chips were not available. The poser for today is to do with subsidies. Now let's come back to the world, or the United States, where the CHIPS Act has set aside almost $40 billion in grants, plus loans and guarantees worth another $75 billion to entice chip companies to build factories in America. And they've all started. Intel will take something like $8.5 billion in grants and as much as $11 billion in loans to help fund an expansion of its semiconductor factories, which in turn will drive something like $100 billion of investments from Intel in large-scale plants in Arizona and Ohio states. Last month, Taiwan Semiconductor Manufacturing Company from Taiwan, the giant of them all, was set to take in about $6.6 billion in grants and as much as $5 billion in loans to help set up factories in Arizona. Bloomberg reported that the package will support more than $65 billion in investments at 3 plants by Taiwan Semiconductor in the United States, which is also, as it says, the go-to chip maker for companies like Apple and Nvidia. So there are 2 questions. First, while India does need semiconductor capacity for strategic reasons, the question is how much can it afford in a global race with rich countries lavishing subsidies of the kind we just spoke of? In which case, why couldn't we just import, or at least some part of it, from these countries who are investing such large amounts in any case, particularly countries like the United States? Now, there are other arguments which say that India should focus these large sums of money going as subsidies for chips into more basic services like health and education. Though I feel the more pertinent question is how much and to what extent, rather than a binary of should we invest or not. To get a sense on all of this, I reached out to Ajai Chowdhury, earlier co-founder of HCL Tech and now a member of the India Semiconductor Mission and a keen supporter of the government's efforts in this direction. I began by asking him for a bit of a status check on the projects announced so far.
Before the India Semiconductor Mission project took off, there was another scheme under METI, and that scheme was called the SPEC scheme. Under that, there was one particular plant that already came up for packaging. So that has started production already, and that is located in Rajasthan. And the company's name is Sahasra Semiconductors. So they have already started. So that's the first packaging unit that has taken off. After the ISM got into place, they announced a separate scheme. And under this scheme, they announced $10 billion worth of subsidies that they will provide to people who actually invest in India. So in the $10 billion plan, the first packaging unit was announced by Micron. And that has already, the construction has already started, and they're talking about taking out the first chip somewhere around next year or maybe late this year. So that production will happen. The next announcement, which was the big announcement that was made by Tata's, was with the PSMC from Taiwan. And they will be making 28 to 55 nanometer silicon fabs. That's a silicon fab. And this, as per the announcement made by Tata's, will get into production in somewhere around 2026 end probably. Typically, it takes a fab 4 years to get going, silicon fab. But Tata's are talking about speeding this whole thing up. So that is where the next big one will happen. That is in Dholera. Another plant that is coming up in Gujarat is the plant that is a cooperation between Renesas from Japan and CG. So that will be a packaging unit. And the other packaging unit is coming up in Assam, which is again a Tata unit, which is going to be packaging unit. So these are the ones that have been announced till now.
Right. Now, what is India's target in terms of how much we want to produce and of what kind? I know it's 40 nanometer broadly, but if you could walk us through that.
Basically, there are 3 specific requirements of India. Number 1 is 28 nanometers and above silicon fab. So on that, one fab has already come in. Maybe one more will happen. I believe there are many proposals. The newspapers talk about Tower Semiconductors from Israel who's interested. So they've applied. Now, the next thing that India needs is compound semiconductors. Now, compound semiconductors, silicon is a single product, while compound semiconductors combine different materials. So that's why they're called compound semiconductors. So that will basically be a silicon carbide fab or a gallium nitride fab. These are also required for very specific applications of India because we have large number of EVs that are going to be produced in India. There's a huge amount of requirement in power sector, and there's a large requirement for even chargers, etc. So this is where silicon carbide or gallium nitride type of semiconductors go. So we expect that at least 2 or 3 compound semiconductors fabs will also come up in India. And lastly, most importantly, a display fab is an absolute requirement, because whichever product you look at, displays are part of the product. So whether you're looking at phones, you're looking at tablets, you're looking at notebooks, you're looking at televisions, silicon, display fabs are an essential requirement. Recently, I read in the papers that Sharp is considering a 3 to 5 billion investment in display fab. Originally, if you recall, even Vedanta had announced it, but that never happened. So this is the range of what our requirements are. And we don't need lower NMSP products. For example, we don't need to make chips for phones today. The semiconductor market is a global market. So you buy from whatever you need from wherever. Even the plants that will come up in India are not just for Indian requirements. They will meet the requirements of India as well as the rest of the world.
The question, one question that therefore springs is, we've committed, let's say, $10 billion or 80,000 crores of subsidies at this point for all these projects. So will that be it for some time? In terms of our needs, because while our needs may be higher, our ability to subsidize these projects may be limited. And that's one. Second is, we're also in a global race with countries like the United States, where the governments there are pouring tens of billions of dollars in subsidies. And this is not a right or wrong question, obviously, but it's a question of who can afford it more. And which is the third part of the question in some ways, which is that to what extent can we, or even should we, be in a race, particularly with countries like the United States, who we can import from in any case?
So you see, our requirements are limited to the large amount of chips that we need for automobiles and white goods, etc. That is really where we are focusing. We don't want to focus on the most advanced nodes. The government has very clearly announced, the minister had said a few weeks ago, that the Prime Minister's vision is a 20-year vision. And in that 20-year vision, they may even spend another $10 billion. And I expect that announcement will happen post-elections, because the job is not yet over. We have already got certain requirements met, but we still have the other requirements to be met, which I just talked about. So I expect that another 10 billion will be put in. And with that, I think we should meet our immediate requirements for the next 5 to 10 years. We don't need to be investing more. Rest of the chips that are required, we can import from Korea, we can import from Taiwan, we can import from the US. So that is the way we should look at it, because, as I said, semiconductors are a global value chain. Nobody makes everything. Now, coming to the United States, United States let go of manufacturing for too long a time. And suddenly, after the geopolitical situation and the threat of China taking over Taiwan, they've woken up immediately. And they've started to bring all semiconductor manufacturing into the United States. They have no choice. They just need to protect themselves today. And therefore, they have got TSMC to come and invest in the US. Because TSMC is pretty much 55-60% of the world's requirement is met by them. They can't afford that risk sitting in Taiwan. So that's why they brought them back. Japan has also taken the same decision. A TSMC plant is coming up there. So they are all diversifying their requirements. As far as the United States is concerned, they believe, since they've got left behind very badly, they are encouraging literally everybody to invest. So Intel has announced major investments there. Intel itself got left behind. And Gelsinger, who's the CEO of Intel, said that I am going to make Intel come back. And therefore, Intel is not going to stay only in the semiconductor manufacturing part, which they started to do 2 years ago. They want to go back to their main business of making chips, and with advanced chips to compete in the new market, because they lost the phone market. So therefore, Intel and the US have decided on major investments. So that's really what's happening today as far as we are concerned. And that's the way it will be. Europe is also working very hard to get more investment. So it's a race to get more and more investments. But all this race is going to be for the lower nodes majorly. And the mature nodes also are happening everywhere in the world. But India needs mature nodes.
Intel, for example, in the state of Ohio is going to invest about $30 billion. And assuming semiconductors are akin to defense in terms of sensitivity and our need to, let's say, own some part of the production chain, you're saying that we will really need to stop or not necessarily go beyond the $20 billion that we will subsidize at this point. I mean, and I'm only coming at it from that point of view right now, because beyond that, our needs will be met. That's one part of the question. The second part is many of these decisions were taken, and rightfully so, in the peak of COVID, and which led to, where we saw a lot of supply chain pressures and so on. Has anything changed in that? I mean, in that from then to now, which either gives us confidence or otherwise?
I think the major change that's taken place is China's threat of taking over Taiwan. To me, that's the most important piece that's happening. Rest has remained the same. But very clearly, the demand for semiconductors has dramatically increased because of AI. And that change that is taking place is also driving investments more and more into semiconductors. You know, there was this person in the United States Senate. He was the Intelligence Senate head. And he had made this statement 5 years ago. He had said, the next wars will be fought with semiconductors. And that's really coming out to be true. So as you rightly said, it's a defense-like situation that everybody is looking at semiconductors. The interesting part of semiconductors is that the business goes up and down, and that will continue. But that doesn't matter because the long term is very, very... The interesting part that's happening is that people like NVIDIA, AMD, and Intel are now running around trying to make more and more advanced chips, which will take up more power. And therefore, you need very large investments and you need to have lower nanometer products as you go forward.
Mr. Chowdhury, thank you so much for joining me.
Thank you.
Warren Buffett appears without Charlie Munger. Berkshire Hathaway's annual meeting drew thousands of Warren Buffett devotees, including many from India, who make it an annual pilgrimage to see the Sage of Omaha, as Warren Buffett is called. But this was the first meeting without Charlie Munger, Berkshire's vice chairman and Buffett's longtime investing partner, who died at 99 last year in November. Meanwhile, Berkshire Hathaway's cash pile hit yet another record as Warren Buffett held back from big-ticket deals, Bloomberg reported, adding that operating earnings also rose thanks to collections from the insurance business. The firm's cash balance increased to $189 billion at the end of the first quarter, topping the record it set at year-end. It also reported first quarter operating earnings of about $11 billion versus about $8 billion for the same period a year ago. Berkshire Hathaway invests in many kinds of companies, but many of them are old economy, including as old as a railroad company. As Berkshire's annual meeting kicked off in Omaha on Saturday, Warren Buffett said it was a fair assumption that its cash pile would hit $200 billion at the end of this quarter, with few opportunities for needle-moving acquisitions on the horizon. He said that we'd love to spend it, but we won't spend it unless we think we're doing something that has very little risk and can make us a lot of money, he told a crowd of thousands. Buffett sold some of its Apple shares in the quarter, reporting a $135 billion stake at the end of March, down from about $174 billion at the end of the year. Despite that, Buffett praised Apple, saying it's an even better business than two others it owns shares in, American Express and Coca-Cola, according to Bloomberg. Apple will remain its top holding by the year-end, Warren Buffett said. Tim Cook, Apple's CEO, was in the audience. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.